Right now, a quiet crisis is brewing, one that could affect millions of people, often without them even realizing it. In homes up and down the country, millions of pension pots are quietly at risk, their future uncertain. You've worked hard, saved for decades, and trusted the system to look after you. But now, your retirement security is more fragile than ever before. The government is eyeing our $2.5 trillion pension savings as a tool to boost the UK economy, encouraging pension funds to invest in riskier assets in hopes of higher returns. But this isn't just about numbers on a page. It's about whether you'll be able to heat your home, put food on the table, enjoy life, or help your family when you finally retire. The days of guaranteed, final salary pensions, where you knew exactly what you'd get, are long gone, replaced by uncertainty. Now, most of us have defined contribution pots. What you get out depends entirely on how much you put in and how well your investments perform over the years. All the risk is now on your shoulders. If things go wrong, it's you who pays the price. If the market tanks just before you retire, your pension pot could shrink dramatically, and so could your hopes for a secure future. The system is facing a radical overhaul, with new rules and reforms on the horizon. You need to know what these changes could mean for you and your loved ones. This isn't just financial jargon or distant policy talk. It's your money, your future, and your quality of life at stake. Decisions being made today in Whitehall could decide whether your retirement is comfortable or a constant struggle to make ends meet. In this series, we'll break down what's happening, why it's happening, and, most importantly, what it means for your hard-earned savings. It's time to get informed, to ask tough questions, and to take control of your financial future, because no one else will do it for you. Your future depends on the choices you make today. Let's dive in and make sure you're prepared for whatever comes next. What does a decent retirement really cost? It's a question that worries many of us as we get older, and the answer isn't always straightforward. Retirement means different things to different people, but understanding the real numbers is the first step to planning your future. The Pensions and Lifetime Savings Association gives us 3 clear targets for retirement living in the UK: minimum, moderate, and comfortable. These categories help us picture what life might look like at each level, and what it actually takes to get there. The minimum standard, about $1,400 to $400 a year for a single person, covers the basics: food, housing, and bills. It's enough to get by, but there's little room for treats or unexpected expenses. At this level, there's no car, just one low-cost UK holiday a year, and not much left over for extras or emergencies. Life is simple, and every penny counts. It's survival, not the dream retirement many hope for. For some, it can feel restrictive and stressful, especially if unexpected costs arise. The moderate level, around $3,100 to $300 a year, means more comfort and flexibility. You can afford a small car, a 2-week European holiday, and have some money for hobbies, socializing, and eating out with friends or family. This is what many imagine as a normal retirement, with a balance of security and enjoyment. But reaching this level takes careful planning, regular saving, and sometimes making tough choices along the way. The comfortable standard, about $43,000 to $100 a year, offers real freedom. You can take longer holidays, dine out regularly, treat your loved ones, and handle life's surprises without worry. It's the kind of retirement most people aspire to. Achieving this level of comfort doesn't happen overnight. It takes decades of consistent saving, investing wisely, and making the most of your pension options. The reality is, most people are far from these targets. Many underestimate how much they'll need or start saving too late. These 3 tiers show us what we're aiming for and just how far we may have to go. They're a useful guide for setting your own goals and tracking your progress. Knowing the numbers is the first step to closing the gap between where you are now and where you want to be. Are you on track for the retirement you want? It's never too early, or too late, to ask yourself this question and take action. For many, the answer is no. But understanding your options and making a plan can help you move closer to your goals. The gap between aspiration and reality is growing, especially as costs rise and life expectancy increases. Understanding these costs is crucial for making informed decisions about your future and your family's security. It's not just about saving, it's about knowing your target, reviewing your progress, and adjusting your plan as life changes. Let's see how prepared we really are. Take stock of your savings, your goals, and your expectations. The reality may surprise you, but with the right knowledge and action, You can shape the retirement you deserve. Now for the tough question, one that many of us tend to avoid, but is more important than ever. Are you actually on track for the retirement you want, or just hoping things will work out? The reality is, over half of working-age adults aren't confident they're saving enough for later life. That uncertainty is growing, especially as the cost of living rises and future needs become harder to predict. Shockingly, 1 in 5 people has no pension savings at all beyond the state pension, leaving them vulnerable to financial hardship. Most people are heading for the minimum standard of living in retirement, or in some cases even less than that. Nearly 40% of over 50s have less than $50,000 in their pension pot, which is far below what's needed for a comfortable retirement. That's just a couple £1,000s a year on top of the state pension, barely enough to cover basic expenses, let alone enjoy life. Even more worrying, most people don't know how much is in their pension, or what that number will actually mean for their future income and lifestyle. We're sleepwalking into a retirement crisis, with millions in the dark about their financial future and what steps they need to take. The system is confusing, filled with jargon, complicated statements, and scattered pension pots from different jobs over the years. Many feel powerless and overwhelmed by the complexity, so they disengage and put off making decisions. But ignoring the problem won't make it go away. In fact, it only makes things worse as time passes. The brutal truth is this: millions aren't saving enough, and many won't realize the full impact until it's too late to change course. Now is the time to take action and get informed. Your future self will thank you. Why do so many of us know so little about our pensions? It starts with a lack of education. Most of us never learned about pensions in school. We're expected to make huge financial decisions with almost no training. Pension statements are dense, full of jargon, and often more confusing than helpful. What people need is simple: a clear picture of what they're on track for, and what to do to improve it. The decline of affordable face-to-face advice has left millions without guidance. Free resources exist, but they can't offer personalized advice. The result? Most people are left to navigate a complex system alone. There's also a psychological barrier. Retirement feels distant, and immediate expenses take priority. Compound interest is powerful, but not intuitive. The system expects rational long-term decisions, but human nature gets in the way. Without better education and simpler tools, we're setting people up to fail. The government's answer? The Mansion House reforms, a major shakeup of UK pensions. First, they want to merge thousands of small schemes into a few giant super funds for efficiency and better returns. Second, they're pushing these funds to invest more in UK companies and private equity. Riskier, less liquid assets. The goal: boost pension returns and fuel the UK economy. This is a huge policy shift, moving from fund manager independence to government-influenced investment. It's a big gamble, using our retirement savings to drive economic growth. The risks and rewards are real, and every saver should pay attention. So, what are private assets or private equity? Most pensions are invested in public assets, shares in big companies or government bonds, traded openly and easy to sell. Private assets are different. They're not traded on public markets and are much harder to sell quickly. Private equity means buying whole companies, improving them, and selling for profit, like flipping a house, but on a bigger scale. It also includes lending directly to businesses, investing in startups, or funding infrastructure projects. The key word: illiquidity. Your money is locked up for years, sometimes a decade or more. Unlike public shares, you can't just cash out. This long-term lockup is both the appeal and the risk. Understanding this is crucial to grasping what's at stake. Why is the government so keen on private assets? The main selling point: higher returns. Private equity has historically outperformed public markets, at least on paper. The hope is that investing in UK businesses and infrastructure will boost both our pensions and the economy. It's a win-win narrative. Savers get bigger pots, British companies get investment, and the UK grows stronger. Diversification is another argument. Private assets don't always move with the stock market, potentially smoothing out returns. The government presents this as a magic bullet for the pension crisis and the economy. But if it sounds too good to be true, it probably is. Higher returns come with higher risks. The benefits are real, but so are the dangers. Let's look at what could go wrong. The risks of private equity are often glossed over. First, liquidity risk. These assets can't be sold quickly, making it hard for funds to pay out or adjust in a crisis. Then, the fees. Private equity charges are sky high compared to regular pension funds, eating into your returns. Transparency is another issue. Private companies don't have to report results publicly, and valuations are often self-assessed. This can make returns look smoother and safer than they really are. Studies show that after adjusting for risk and fees, private equity's outperformance often disappears. The real winners may be the private equity firms, not pensioners. We're being asked to take on more risk, pay higher fees, and accept less transparency for returns that might not even be better. So, are these reforms a fix for savers or a windfall for the city? Consolidating small pension schemes into super funds is a smart move. Lower costs, better governance, and more expertise. But forcing funds into high-risk private assets is a gamble with our retirement security. The arguments for higher returns and economic growth are appealing, but they hide the dangers of high fees, illiquidity, and lack of transparency. Pension funds should focus on delivering the best risk-adjusted returns for savers, not on propping up government policy. If private equity was truly the best option, fund managers would already be investing more in it. The real solution? Better education, clearer information, and higher auto-enrollment savings rates. That's what would truly help savers. Otherwise, we risk turning our pensions into a feast for fund managers at the expense of our own futures.